Hey guys, welcome to today's show. On the Final Bar, we are going to do our normal Friday routine of wrapping the week. We'll take a look at some of the longer term trends, how this week's action fits into that long-term picture. We're also going to open the Final Bar Mailbag. We're going to answer some of your questions about the AAII rankings, measuring investor sentiment, also looking at long-term investing styles and so forth. Also give you a quick preview of our special interview with Ralph Atkimpora. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in an increasingly snowy Redmond, Washington. Thanks for joining us today and every weekday on StockCharts TV to unpack today's price action, connect it to the longer term trends, and try to put things in proper perspective. Fridays are one of my favorite days to do the show because we get to do a Wrap the Week segment where we really think about the long-term trends. It's so easy to get caught up in the short-term movements and the short-term day-to-day fluctuations. The end of the week is a time to sort of look back, see what's happened over the course of the last 5 trading days. Start to think about how you want to approach the coming weeks, right? And what sort of thematic moves have have come out of the price action. So today we have a bit of distribution, or a little sell-off, which we're going to look at. Bearish engulfing pattern on the S&P 500. That does not happen very often. So we're going to think about those and many other tidbits of visual information. Before we get too much into that, though, before the recap, I did want to point out some of the events we have coming up. Some really cool stuff in store for you on the Final Bar. Next week on January 15th, we're going to have Katie Stockton. On January 16th, Doug Bush, both really capable technical analysts. Really excited to get their point of view on where we're at in terms of the market environment. The week after that, on the 21st, we have Greg Schnell, one of our StockCharts contributors, focusing on U.S. and Canada especially, and then Greg Harmon on January 22nd to share his perspective. Also, please make a note, on January 22nd, we are going to present our 2020 market outlook. This is me along with many of my fellow contributors, all sharing, a couple minutes of our take on the world going into this year and through the course of the 2020 trading year. So make sure that you check that out on January 22nd. Let's get to our market recap. So, usually I feel like when we've been doing this recap every day, it tends to be sort of a pretty rosy picture as we continue to sort of trip higher. And I can't remember the last time I've actually told you about a down day. It hasn't happened that often, but today we finally sort of had it. So I switched to candlestick analysis. Usually this daily chart of the S&P that I show you is a bar chart. That's sort of my go-to, but I've used candlesticks at parts of my career much more often, and I wanted to show it to you here to highlight the bearish engulfing pattern. So this is when you have a strong up day or a clear candle, an open candle, followed by a down close or a solid candle, and that the range of the second day open to close engulfs the range of the first day. You call that a bearish engulfing pattern. It has not happened very often on the S&P 500 because you've had this continued building of momentum, right? This continued unabated uptrend. So, in general, what does that mean? That essentially means in the short term, the next 2 to 3 bars are probably more often than not going to be weaker rather than stronger when you see that sort of pattern, because what it means is we opened in a position of strength, we finished in a position of weakness. There was distribution during the trading day, pretty slow and steady distribution over the course of the day, and giving you sort of a bearish signal from candlesticks is the read there. Now, what's interesting here is how that lines up with what we've looked at and what we've been talking about for a couple weeks now, right? You have this non-confirmation or this bearish divergence, whereas the price goes higher, the RSI starts to slope downwards, right? So you have lower peaks in RSI. Every new high in price is matched with lower peaks in the RSI, and that tends to be sort of a negative configuration, telling you that there's more, less and less momentum every time that the S&P pushes higher. This is what today's trading actually looked like. You can see it was a pretty broad distribution. This is the spiders looking back at the last trading weeks. This is the last 5 days here. And you can see overall, if you just zoom out and look at the last 4 days, pretty consistent, slow and steady gains, even with some distribution going into the close. You kept going higher. Today's the first day we really start to see an unwinding of that sort of profit taking going into the weekend. And again, the question now is, what does that mean for the week as a whole? What does that mean going forward? And as we go into our Wrap the Week segment in a little bit, we're going to certainly think about that along with many other themes. I think what's interesting as the S&P is showing that bearish divergence, you have a lot of stocks that aren't quite there. They're showing you something a little different. So this is Apple, for example, which is closed just about at the open, up a little bit, sort of a token up day. And again, on a day when a lot of the market was lower. But look at how it's extremely overbought with an RSI still above 80. That usually means that the upside momentum is so strong, you'll probably have a bit of a pullback before at least one more move higher. Apple, coincidentally, the #1 ranked stock out of the entire large cap scooter ranking. So out of a couple hundred, pretty significantly sized names, Apple is literally #1. Huge benchmark name at the top of the list. Let's finish off the recap today looking at the market dashboard. Your member dashboard page should be one of the main things you look at on our platform. We can see the S&P was down about 29 basis points, 0.29%, followed by mid caps, followed by small caps. So small caps are actually down the most, mid caps down a little less, and the S&P large caps down the least. Interesting to know that Dow Industrials represents a lot of the mega cap names, but in a number of different sectors down almost 0.5%. In terms of sector moves, real estate, utilities, #1 and 2, with real estate really the top by far, up almost 1% on a down day. So, certainly a flock to more safety, more yield, more income-oriented sectors with real estate and utilities. At the bottom, we have industrials, we have financials. Also energy, and I tell you what, energy has seemed to be weaker on up days and on down days, so no real alleviation of negativity there. But interesting to note in the consumer space, you have discretionary down about 0.5%, with staples about flat. So that consumer discretionary to staples ratio that we talk about pretty regularly, looking pretty interesting. Actually going to rotate a little bit more back to staples. Let's finish off with looking at some of the broader market themes and then looking at a couple industries here real quick. Remember, in terms of global ETFs, Asia ETFs actually did very well, with South Korea up the most today, followed by the MCHI, that's one of the China ETFs, drifting a little bit higher, new closing highs today. And again, there are a number of different ways to look at the Chinese markets. That's one of the main ways that I tend to do it. On the downside, you have a very commodity, very oil-oriented ETF, Brazil, the EWZ, followed by some developed markets in Europe and in Asia. In terms of sector and industry themes, home construction up the most. If I remember right, I think this is one of the top 10 industries yesterday as well. So, kind of showing you a little bit of a strength there. But what's really interesting, if you look after that, it's materials, and gold miners have been incredibly weak relative to others. There were some of the top industries, followed by a bunch of real estate, a bunch of REITs. The rest of the top 10 is dominated by REITs. And again, these are some of these have been in real cyclical downtrends. Something like specialty REITs has actually been kind of sneaky, actually looking pretty good with a healthy dividend component as well. So might be interesting if you're not really, a lot of people sort of mentally push REITs out of their thinking. There's so many other things that we probably know better, but don't ignore some of those. Looking at that industry scooter page can give you a good, or the industry summary page can give you a good sense of some of the industry breakdowns where there might be some opportunities that you don't know about. Our next segment is called Wrap the Week. This is our exercise every Friday to sort of take a look at what has happened over the last 5 days, but then try to put it in a broader context. We try to do that every day, but Friday especially, it's a good time to sort of take a step back, take stock of where we've been and where we're headed to. Interestingly, we asked a poll question of all of you on screen. And I wanted to share just with you some of the results before we get into some of the charts and what they're saying. We asked you, in the next year or so, do you think the stock market will go up or down? We had over 700 respondents, and thanks all so much for responding. 3 out of 4 of you said up. You think the market's going to go up this year, finish the 2020 in a higher position than it is now, and 24%, only 1/4 of you said it was going to be down. That's interesting, and it lines up a little bit with the AAII rankings, which we're going to talk about later in the show when we get to the mailbag segment. But what's compelling is the fact that 3 out of 4 of you are pretty bulled up, are pretty positive, at least that we're going to be stronger than where we are where we are today. Let's look at some of the charts and see if we can, I don't necessarily want to change your mind, but let's look at some of the evidence and see what we might be able to draw from that. I like to start with the Mindful Investor chart list. This is a chart list that I maintain. It's part of my weekly exercise to go through these charts. If you're not familiar with this, you can get to it. Just email me at thefinalbar@stockcharts.com. I'll send you a link to this list, and then you can click on Save to Chart List, put it in your own log, and you can follow some of these going forward. So in terms of putting the weekly action into perspective, I love to start with the long-term picture of the S&P 500. This is a 5-year weekly view of the S&P. This is using one of the trend-following systems that I've used for a number of years. It's using the 21 and 34-week exponential moving averages. It's a very long-term exponential moving average combination. It's designed to just give you the overall long-term secular trend, and you can see this is clearly in a position of strength, both of those sloping upwards. This is the PPO, so showing you the difference between those two, and you can see overall, as long as this is above zero, it tells you the trend is positive, and that's what we've seen. I also look at a shorter term indication. This is more of a tactical read. This is using the PPO on a shorter time frame, similar to MACD, if you're familiar with that indicator, the weekly MACD. And again, when this crosses up through the signal line, that tells you that the short-term trend is up. So here we have a long-term bullish trend, a short-term bullish trend, really indicating the strength that we've seen from stocks over recent weeks. This is looking at breadth using the S&P 500, the NYSE, also mid caps and small caps. So what I'm seeing here is the fact that the S&P's gone higher. The breadth is at new highs again this week, which makes sense, sort of following through on the strength of the large mega cap trade. But if you just glance down through these 4 lines, look at how you get smaller companies lower in the cap tier, and you can see how these breadth lines are starting to turn down. So the small cap breadth line actually lower over the last 2 weeks, while the S&P is actually closing to new highs. So it shows you that the broadest, largest companies, the large cap S&P names doing very, very well. But if you get smaller in the cap tier spectrum, the smaller, more speculative companies, those are actually on average rotating a little bit lower. So, again, maybe one red flag among others to keep in mind here. Here we're looking at new highs and new lows, and I just show you that. And again, this is not updated for today's trading yet, so it might be a little different based on the sell-off, the bearish engulfing pattern on the S&P that we mentioned earlier. But up until today, you can see every day this week until Friday, we've had more and more new highs on S&P names. So, yesterday you had 81 out of the 500 companies going to new 52-week highs, new 52-week closing highs. So it'd be interesting to see if we had a big change in that. I wouldn't imagine, probably less stocks, but not a huge negative signal by any mean. Here we're looking at breadth in the form of the percent of stocks above the 200-day and above the 50-day moving averages. And I would just point out, again, the fact that so many S&P names are above their 200-day. It's almost 84% now, just above 83%. That is an extreme high for that reading. And it lines up very well with previous extended markets. Even if the primary trend remained positive, it was sort of a corrective period. And I think any strategist you'd talk to would say we're very much overdue for some sort of pullback, some sort of way to digest the gains that we've experienced. Maybe this is an indication that we're near that point where that would happen. We have not seen it yet. Here we're looking at the consumer discretionary versus consumer staples. As we saw, staples outperform consumer discretionary today, which is why this ratio is kind of coming down a little bit. But overall, we've had this rotation, and that uptrend in that ratio is not in question at this point, I think, yet, because we haven't pulled back enough to where you'd think that's alleviated. So overall, we're seeing a broader rotation into consumer discretionary. If this ratio turns lower, I think that would be very telling you that people are taking profits on some of those high-flying consumer names they may have been up until now. And this might be one of the places where that's reflected. This is the equal-weighted consumer discretionary versus consumer staples. You can see that that's relatively flat. I wanted to switch gears now and go to our scooter rankings. This is one of the places where I like to think about movements and rotations. I did want to do the 1 week changes. We're going to look at industries. This is one of the places I like to focus on what's happening and what's evolving. I would note the strongest industries out there, a lot of technology. So you have computer hardware, you have semiconductors, but you also, and internet, but you also have a lot of other sectors. This is in consumer discretionary. You have the automobiles index, things like Tesla are incorporated into things like that. Specialty finance, and again, on the financial chart, the XLF has looked weaker than something like technology, maybe even healthcare, because it's pulled back a little bit, but specialty finance in particular has done really, really well. It's one of the strongest. Again, this is sorted by the industries with the strongest scooter rankings on an absolute basis right now. Let's look at what's moved. And so what you do is you resort the whole table, put it on 1 week, sort it on change, and this will show you which industries have moved the most. Really interesting to see that as of now, tobacco was one of the biggest gainers. This is a quick snapshot of the tobacco index. You can see how it's rotated from a negative phase in August, September into October, and then just being in a really bullish phase. It's been sort of a slow and steady gainer. Tobacco names are stocks that I feel like people love to hate. But if you look at this, it's tobacco, it's distillers and vintners. These are all, sort of consumer staple types of names. You then get into personal products and then biotech. The biotech trade is a really interesting one. This tends to be more of a risk-on type of bet. And when biotechs are doing pretty good, same as semiconductors, I think you have to feel pretty good about the broader market. It's definitely in a position of strength. And rounding out the top 5, you have brewers, which overall had been relatively weak and still are. But you can see on the little preview that the price has started to emerge to the upside. In terms of the big losers this week, it's in materials, folks. So it's things like mining, it's gold mining index, and then going into clothing and accessories and some of the other energy and other related telecom industries. So we just touched on this. I'd encourage you to spend some time either tonight or over the weekend, look at the scooter reports by industry, sort this on some different ways, and you'll get a good read on what has sort of evolved over time. Next, I wanted to share with you one of the really cool experiences I had recently, which is sitting down with Ralph Acampora. We've shared pieces of this interview when we sat down with him at his farm in Minnesota, outside of Minneapolis. I had spent a fantastic, unforgettable day talking about his 50 years on Wall Street and what he had learned and how he used that experience and was inspired to create an incredible, very unique visualization of the markets directly on his farm. Here's a quick preview of what you're going to see coming up soon on StockCharts TV.
I was staring at the north wall of my barn.
Okay.
It's plain, it's boring, it's this whitish color. Mm-hmm. It's 70 feet long, it's about 18 feet high, and just blank. And I said to myself, 2017, I'm going to be 50 years in the business. Wouldn't it be cool if I could just put the history of the stock market? That's where the idea came from. I wanted to capture my 50 years.
So that was just a quick preview of a fantastic show that we've created for you, highlighting the time that we spent with Ralph Acampora. Talk about an incredible 50-plus year career as a Wall Street strategist. He has some fantastic memorabilia from over the course of his career, but the visualization he did on that barn, we literally walked around it together. We're going to share a lot of that story with you. We have a really talented team here at StockCharts TV in terms of producers, graphic designers. They really did a fantastic job with it. So we're super excited to share with you in the coming weeks this special moment, a special set of moments we have with Ralph Acampora. So coming soon to all of you. Now we want to move on and share with you the Final Bar Mailbag. What I love about this show is the interactive nature of it. You can send questions to us anytime, thefinalbar@stockcharts.com, and we love to share your questions and answer them on air as much as we can. So one of the questions that we had was about the AAII rankings. I showed you yesterday, I think it was one of the 3 and 3 charts was the AAII rankings and showing the bullish number that has come down over the last couple of weeks. The question specifically, and this was in our chat room, sorry, this actually might have been over Twitter, I saw this one. Does this count as an emerging bearish divergence, right? And he's talking about the price going higher, but the AAII rankings going lower. So, you know, the answer is yes and no. And I'd love to share with you now just how I think of these AAII rankings and other survey-based data, and then what I think it means. So is it a bearish divergence in that price is going up and the indicator is going down? Absolutely right. And you can see that just on the number of bulls, on the percent of bears, which have been increasing, so another sort of confirmation of negativity. This is also, I didn't show this yesterday, I don't believe, but this is the spread between bullish and bearish. You can see it had gotten to an extreme, almost 25% difference between bulls and bears, and that was just a couple weeks ago. Since then, that has completely narrowed, and now you're almost dead even between bullish and bearish respondents. So is that a divergence? Of course it is. The real question, I think, though, is that an actionable signal? And that's where I think not necessarily. So for me, I like to use things that I think are statistically provable, that are statistically relevant, and that make legitimate sense. There's a reason why the statistics shown on the screen should give you a good actionable signal. And something like RSI, something like MACD or PPO, even things like trend lines, I've learned give me an edge in terms of understanding inflection points, rotations, and momentum and trends. Something like sentiment in the form of survey ratings, you have to remember that this is telling you how people are voting with their mouth, how much they're, are they saying they're bullish or bearish? Whereas price itself tells you how they're voting with their feet, voting with their assets, right? So this tells you what people want to say. The other chart of price is telling you what they're actually doing. So is the fact that there are less and less bulls an actionable signal telling you the trend is exhausted? I don't think so. I tend to think of the AAII, the American Association of Individual Investors. I tend to use this survey data more anecdotally. I like knowing when there's an extreme in sentiment, when there are more bears than there ever have been, when there are more bearish voters than there have been, when it's at an extreme, when the spread between bullish and bearish is significant. But I would not trade a system of any sort based purely on this. I think of it more as a way to think about what other charts I want to look at to start to find validation in price and momentum. So overall, the lessening of this, for me, speaks more to the mistrust or distrust or lack of trust that investors have with this the last couple weeks. There's sort of a disbelief that the stocks in general should be going higher. There's an expectation that we have a pullback, and that's what this ratio is telling you. So that's the way that I would answer that. Thank you so much for the question about the AAII rankings. Still think it's very, very valid to look at for sure. The second question came in the chat room yesterday on the show. We were talking about a number of broad market signals, and the question was the S&P 500 Bullish Percent Index rose above the 80% level today. Do you think that is an extreme level? You know, that was a great question, and that it was a reminder to the host here that I should be thinking more about Bullish Percent Indexes. Anytime I talk to someone that uses these, I always make a note, like, why am I not looking at these more often? I'm going to try to make a point of incorporating them into my process, into the show more often, because they're really, really interesting, and it's a unique way of looking at breadth in terms of what percent of stocks in a certain universe are in a bullish or a bearish signal based on point and figure charts. Now, this is on the market summary page. You switch it to end of day and you'll see a listing of all of these Bullish Percent indexes. You can use them however they went. They were designed by Abe Cohen a number of years ago. He's one of the pioneers of point and figure charting, really brought it to the masses, I would say. And he talked about using all of these as a way of rolling up stocks that are in bullish or bearish signals. So they broke into a new, broken above the previous column of X's or below the previous column of O's, and this gives you the percent. The way that they were really intended to be used is on a point and figure chart itself. So this is the Bullish Percent Index on the S&P 500. I'm looking at it on a point and figure chart. And essentially, this is, I believe, what they were talking about. It's above the 80% level. And the question was, is that an extreme level? The answer is it's absolutely at an extreme level. And the way that Abe Cohen envisioned using this is the signal, the indication you're looking for, is when it breaks above that extreme level, breaks above 80. The last time you saw that was back here on the chart. And then it goes to a column of O's, which would mean it's a 2% bar, which means it would have to go at least 6% down in the other direction. So this is not a sell signal. This tells you we're at an extreme. The sell signal would be when you have a column of O's that starts to go down, which would tell you there's been a change of at least 6% of the percent of stocks. And so basically a number of stocks will have rotated from a bullish signal to a bearish signal. So that's what you'd be looking for on the Bullish Percent Index. If you're not familiar with everything I just said, made absolutely no sense, do yourself a favor, go to our chart school page, look for Bullish Percent Index. You'll see a fantastic article that goes into more detail about what I was able to share with you here today. Our third question, and thanks again for all of these questions, and I'll read it. This came via email, thefinalbar@stockcharts.com, and the person sent, Dave, you mentioned you're a long-term investor. Do you invest in individual stocks or an index fund? At any time, would you sell your long-term investment to reserve your profits? It seems to me, why would you give up profits for a 50 to 70% decline? Great question, and I hit that a number of times. I'm more of a long-term investor. I'm not a swing trader. I'm not a short-term investor. So in terms of what that means, listen, when I talk about being a long-term investor, it's all about what time frame you're trying to operate on. So for me, I tend to be looking 3, 6, 12 months out. So when I'm looking at a 5-year, 7-year weekly chart, that's kind of my go-to investment chart because I want to take that time frame and then project forward and start to anticipate what the next 6 to 12 months is going to do. Now, what that means, let's say overall, I think the trend in Apple is positive, and I think that the trend is positive. I'm going to continue to follow it. If there is a sell signal, if you get a legitimate sell signal, there, by no means being a long-term investor, does that mean you have to wait a certain period of time to sell a losing position? Ned Davis once told me, all of your big losses begin as small losses. So you don't want to hold on to something until you've given away half the investment just as a signal to get out of it, right? Part of being a long-term investor is having a good exit plan in place. And I often relate investing to flying, learning to fly an airplane. You always have an emergency preparedness plan, right? Regardless of what you're doing in the airplane, you have a backup plan. You have an exit strategy. If you lose your engine, if the propeller falls off, if the wing goes away, you have a plan in place. You know where you can get the plane, how you do it, what steps you need to follow it. As an investor, you need to do the same thing. So being long-term investors does not mean you need to be locked into a certain holding period. It just means you are trying to not trade short-term trends. You're trying to trade long-term trends, but you always have your eye on risk. So thanks so much, all of you. Those are thoughtful questions, and I hope I've been able to answer them in some small way today. But we folks need to close out the show with a 3 and 3. So at the end of every show, 3 charts in 3 minutes. If these are not on your radar yet, I hope they are as of this moment. Because we wrapped the week and we looked at a lot of broad market charts, I wanted to just finish the day looking at 3 individual stock charts. So, and I do this to highlight the fact that regardless of what the broad market is doing, time with Peter Lynch taught me that he always was able to find good ideas regardless of the broader market environment. I just want to highlight the fact that there are plenty of constructive charts out there. The first one, Coca-Cola Company, right? This is sort of a rounding base pattern. You had the high from September. We tested that high again in October. Found a lower low in November, but then once again tested that resistance level just above 55.50 or so. We have now arguably broken above there. We had sort of a bearish candle today, sort of a shooting star candle, open and close at the lows and a higher upper shadow. So short term maybe a little weaker, but overall, I like this basing pattern. If you do get a confirmed break above, potentially showing you some further strength. The second chart is American Express. So in the financials sector, this is part of the consumer finance group, very similar to Coca-Cola, but here we have an interesting play with the 200-day moving average. It's retested it a number of times after testing a Fibonacci support level. That was a really good level to bounce off of. We retested the lows around 114, 113.50 here at the beginning of December, and then rallied back. And this is a little earlier on, but I'd be looking very closely at that resistance level, just above 128.50, which is what we saw last July. If we break above there, if we have a confirmed close above there, that tells you AXP, one of the Dow members in the financial sector, in a position of strength. The relative strength ideally improves there as well. The third one would be Home Depot. I love charts that are in a long-term uptrend that have shown some short-term weakness. So big long-term trend, the last year is strong. The last month has been a little weaker. I think that's the configuration you potentially saw with Home Depot back here in December, pulling back to a position of weakness, but within a longer-term strong position. And now we've seen a rotation back above the most recent swing high. We now have a higher low. We have a higher high breaking above the point here. We've now broken back above the 50-day moving average. I would love to see that trend continue, maybe see an improvement in relative strength, and a chart like Home Depot starts to look a little more constructive. So those are 3 individual stock charts. And again, this is not telling you that these are the only good charts out there, but just to represent the fact that there are always opportunities out there if you know where to look. And ladies and gentlemen, that is our show for today on a Friday here in Redmond, Washington. Thanks very much for joining us every weekday after the close for the Final Bar. Please keep your questions and your feedback coming. The Final Bar at StockCharts.com. The questions we addressed today in our mailbag segment all came from you, the viewers. We'd love to get more of it, and also feedback about how we can do this whole thing better. I want to thank you again for watching. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a good weekend.